Hello everyone and welcome. Welcome back to our DBS Economic Insight series this Wednesday. For those of you, of course, who don't know me and who weren't here for the first couple, my name's Oriel Morrison. I'm so pleased to be back with you again as your host for this event today. Now, of course, as you would know, our conversation today is going to surround the forecast for this year, for 2022, which of course is the year of the tiger. Not been a very auspicious start to the year, as most of you would know. The US market, of course, spending a lot of time in correction territory. The sell-off has been seen in markets right around the world. So that's, of course, not a great way to start. Front of mind, of course, as you would expect, Russia and Ukraine, the geopolitical situation there, that's causing a lot of fear in investors. Not just because of what's happening now, but the impact. You know, in the market sense, of course, that largely impacts oil prices, therefore inflation. Food inflation is in that bucket of concern as well, and it will impact the safe havens around us also. China's another issue that we're watching. It's, of course, has been seen as the engine of global growth. That's slowing down. We've got property prices collapsing over there, so something to watch too. And of course, I mentioned inflation. The rising threat of inflation can't be ignored. In fact, it's very much front of mind for investors out there. Rising rates, also on top of all of this, around $250 trillion of global debt is where we're sitting right now. And of course, we can't forget COVID-19 and of course, Omicron, which is the current variant of concern. Now, I know I haven't painted a very optimistic picture right now, and I should say I do know that Taimur is feeling pretty upbeat despite all of this. So I've got his work cut out for him today. We're going to grab Taimur in just a moment. Just before I do, couple of admin points to mention. First of all, I'd encourage you to ask any questions that you like during the session. We're going to be answering them towards the end of the session today, but ask them at any point. You can do that using Pigeonhole. Use the widget on the webinar page that you can see, or you can scan the QR code on the screen to access Pigeonhole. Or finally, there is a third way. You can key in dbs.pigeonhole.at into your browser, and you can use the passcode there, Insights at 2022. Secondly, I wanted to mention our polls today. Now, we've got two poll questions we're going to put to you. We're going to put one to you in just a moment. Then we're going to put it again to you towards the end of the webinar today, just to see if anything that Taimur and I have discussed over the course of the next hour is actually going to change your mind in terms of what you're thinking out there in the market. So again, you can access those poll questions in the same way. So let me bring them out right now. This is our first poll question. What risk do you rank as the most serious for 2022? Is it number one, China's economic slowdown? Is it US Fed rate hikes? Is it Russia versus West tension? Is it emerging debt overhang? Or are you not really sure about what those risks entail? Now, we can see that there are some of you answering those questions now, and while you get there, and I'm actually quite surprised by these results. Let's bring in Taimur Baig. Taimur, it's always so good to see you.
Hi, Oriel. How are you doing? Great to be here with you today.
I've got your work cut out for you. I know you're optimistic. We've had very positive chats, but wow, I mean, the situation as we see it in the last couple of days kind of changes.
By all means. Absolutely. I feel bad that I don't have like 7 slides just on history of Russia and its relationship with the West to start off with.
Well, look at this. So this is more. These are moving quickly, obviously, as we get some more votes and more people polling today. This is what I expected to see: Russia versus West tension being the number one risk. Maybe not for 2022 though. Maybe not for the entire year, but certainly for where we are right now. Are you this result expected?
Oriel, I think I'm particularly grabbed by the final answer, which is I'm not sure, representing more than a quarter. And that tells you that there is a confluence of risk that's building up. We'll talk about the positive stuff later, but let's just recognize that there is quite a bit of risk out there that is prompting portfolio managers, investors, C-suite executives in companies. They worry about the near-term macro, they worry about the long-term, but clearly right now, on the back of everybody's mind is Russia. But the fact that a third of the respondents so far basically saying they're not sure tells you that there is this need for clarity. There is this sort of hope that things work out. But right now it's so cloudy, you can't really see the horizon.
Yeah, and this is exactly why we have you here with us today, because you are going to be answering all of those questions for us. Now, just before we kick that off and focus in more on what's going on, let's bring up the second poll question, because we do want to see if our viewers change their views over the course of the next hour. The second question is, which asset class do you think will perform the best in 2022? Is it developed market equities? Is it emerging market equities, developed market bonds, emerging market bonds, or cash? And of course, we can see these results once again live as you're answering that particular poll question. So here we go, developed market equities, almost 43% at this particular time.
One thing, Oriel, just to be clear, so one basically has to go to dbs.pigeonhole.at/insights22, right? That's where people are going to go and vote. Yeah.
Yes, correct.
Just making sure of that.
Yes, correct. That is where you will see the poll questions, and that is where the attendees can actually get in there and vote and tell us what you're thinking. It's pretty close now between cash and developed market equities.
And I would equate that with that third of the respondents in the earlier question who felt that they didn't have a very strong view as to what the biggest risk was. And if you have that lack of clarity, then I suppose you'll hide your money under your mattress or just keep it in the checking account.
So when it comes to Russia, Ukraine, Taimur, because of everything that is going on right now, it is causing a lot of concern in the markets. People don't know what's going to happen and what the end result is going to be. How do you factor this into any kind of forecasting that you're doing from this point on?
So I think the first answer that everybody wants is, what is the next step for Russia? And I think having read President Putin's speech at the Duma that was submitted the day before yesterday, it seems to me that Russia is certainly not done in terms of its territorial ambition or in terms of its greater vision for a land for Russian-speaking people. I mean, these are disturbing rhetoric, but it is what it is. It is the reality of a fairly powerful person who's leading a nation, lots of firepower. If Russia does have more aggression in mind, we can be sure that that would manifest in higher commodity prices, particularly natural gas. Although Russia is a fairly large exporter of crude oil, the area where it really holds the ace is the natural gas supply to Europe. And natural gas is not as fungible as oil. So there can be episodic areas, time and as well as in geography, where we can see very, very large spikes and destabilizing impact on the market. In general, at times of worries and risk aversion, you will see flight towards safety. So although we will spend a lot of time today talking about likely rise in interest rates in the near term around all this uncertainty, one would probably expect the opposite. And similarly, in the area of oil, you would expect that worries of war should mean lower demand. That should have a lower impact on commodity prices. But since this is about a very large commodity exporter, and some of the sanctions would probably end up impacting supply of commodities, we probably will see commodity prices go up, which is, of course, bad timing. As we all know, a large part of global inflation over the last year or so have come from commodity prices. And one of the charts that I'll show you later will show that the base effect was just about to kick in, and we were actually going to see popping up of inflation because of base effects, but that may not happen if this crisis continues to unfold. So risk aversion, spiking commodity prices, clouding the inflation picture and trajectory are probably the two most obvious ones. But as far as markets are concerned, I can see that there is still a sizable number of respondents who are still invested in developed market equities. And I think the reasoning behind that is if you look at past conflict, not the Second World War, but subsequent conflicts over the last 70, 80 years, you see that the markets actually don't necessarily go into a prolonged funk around conflicts. Conflicts are typically, or armed conflicts are typically short-lived. There are resolution around them, and the markets tend to move on pretty quickly, whether if you think about the U.S. interventions in Iraq and elsewhere in recent years, or Afghanistan for that matter. So I will say those three things. Don't worry too much about the markets. They tend to correct and recover pretty quickly around armed conflicts. Do worry about commodity price inflation if aggression in that area of the world continues.
So the concern, I think, is, to your point, commodity price inflation, that's going to do damage to inflation all over the world. not only that, at the same time, you're likely to have slower growth because of those higher commodity prices. What's the risk then of recession, certainly at the more at-risk economies?
So the way to think about recession is, there is what feels like a recession versus what is the academic definition of a recession. The academic definition being 2 consecutive quarters of negative outturn as far as GDP growth is concerned. Let's put that aside. I think that's a rather unlikely scenario. But we're coming off a bit of a high. Post-pandemic recovery has been going on for a few quarters, although we're not past the pandemic. We're sort of living with it. And as a result, earnings have been boosted. GDP growth has bounced back from the lows of 2022, robust numbers in 21, and 2022 ought to be a decent year. If indeed we see inflation-related nervousness percolating through the market that prices in very high degrees of fiscal tightening, monetary tightening in the US, that of course will have an impact on economic activity, which will slow, let's say, housing, perhaps durable consumption, perhaps even to some extent some investment. That will slow growth, and even though that may not slow growth to the extent of having negative GDP outturn, it may feel like a recession because we're coming back off a high. That, in my view, is plausible. I would not consider that as a trivial probability outcome.
How plausible?
I would say 15 to 20%.
Well, that's a big enough percent to cause that concern, right? And you add into that, of course, food price inflation, because we're talking about grain out of the Black Sea region. I know that this is not nearly as significant, of course, as oil and natural gas and that feeding into inflation overall. But food inflation is likely to see an impact also.
Yes, particularly with respect to grain. On soybean and corn, 2 other big things that we consume around the world. Soybean also goes into feedstock, and of course, corn goes into sugar. Those things, I would say, the rest of the world outside of the conflict region has ample supply, and we don't have to worry about it. But on grain, there's certainly some things to worry about. And all of this is coming at a time when, in general, energy prices going up pushes up all prices, all production costs, including that of agriculture.
So let me ask you a very broad question then, Taimur. How do you play inflation over the coming months? I mean, if this is the biggest challenge that is facing investors, putting Ukraine, of course, aside for just a moment, we've got a bit of a market consensus appearing that inflation's likely to peak in the second quarter of 2022. Now, if you imagine that Russia-Ukraine is not going to develop into a full-blown crisis, that could then fall back in the second half of the year. If indeed the Russia-Ukraine situation does, then that might not necessarily be the case. But how do you play inflation, and how do you play the uncertainty surrounding that?
Right. The glib answer would be to play cryptos and gold, but we're not going to go there yet. We may come back to that later. Look, clearly, and high inflation backdrop is seldom a good outcome for fixed income markets. And that itself is very problematic because we are on the back of 3+ decades of a bull run on fixed income markets. And therefore, to say, well, I'll be underweight Treasury itself sounds like something that most people, perhaps every single person on this call, has never heard in their professional lifetime. Because from the early 80s onwards, it's always been a bull run for bonds. But surely in the near term, the risk reward is the opposite. Now, normally, when you don't want to buy bonds, you go into equities, but equities have an issue related to valuation, about it being stretched, and some of the liquidity provisions that the Fed will likely withdraw probably will be negative for equities as well. Which is why I was sort of intrigued to see our respondents, in about 40% of them, basically saying that they're still pretty bullish developed market equities. I think primarily because some of those companies are outstanding companies. Some of these companies generate very high cash flow. Over the last 2 years, they've shown their ability to absorb major demand and supply shocks, right? And therefore those companies remain buy and hold as far as global investors are concerned. In fact, I have seen some data in the last few days that some of the outflow of the bond funds is not materializing in gold or cash, but actually going into equities, more to the liking of those 40% respondents that we saw. So if you have a long-term investment horizon, this might be a very good time for you to actually buy some companies that were very expensive the last couple of years and that are becoming reasonable. I'm not talking about big tech. Big tech is still pretty stretched because they remain in high demand. But on the emerging tech, which has been, decimated in the last 3-4 months, there's surely for a stock picker, there are opportunities out there. And just to round up that argument, it's not just a question of developed market bonds and developed market equities, whether it is Chinese bonds or emerging market equities, we see lots of opportunities.
Does inflation pose a lesser challenge out here in Asia, do you believe?
Well, in Asia, there is no difference between core inflation and headline inflation. If food and fuel are going up, that's a big enough problem. There is no hiding behind, well, those are transitory dynamics and we're looking at core expectations. Central banks here have to act if you have very high food and fuel inflation. Has it manifested so far? Not quite. I will show you a chart a little later where you will see that inflation momentum in Asia is also picking up, not as high as Europe or the US, but it's picking up nonetheless. It's something that one needs to keep an eye on. But there are a whole bunch of countries in Asia where you have domestic supply of food balancing out deepening import costs. In some cases in Asia, countries benefit from higher commodity prices. So the picture is a little more mixed. I'll give you a non-Asia example to illustrate the Asia inflation point. Right now, in the last 1 week, only one asset class has rallied in an unambiguous manner. That is Latin American equities, because lots of Latin American countries are exporters of commodities, and they feel that this is where they're going to ride the coattail. So they have issues related to inflation. They have worries about food and fuel import price going up, but they're benefiting from higher commodity prices. Similarly, you would think countries like Indonesia, Australia, Malaysia, whatever the inflation outturn is, we'll probably be seeing a bit of a bull run.
Now, you mentioned that you've got some charts to go through, and I'd like to just give you a moment to go through some of them because they tell a very interesting story. But just one more question before you do. Is there any risk right now, in your view, of stagflation?
Yes, there is a decent risk of stagflation. And let's talk about light stagflation. We're not talking about the 1970s style outright recession and persistent 7, 8, 10% inflation. That's not going to happen. You can see from the credibility that central banks have, the expectations that consumers have, and I'll show you a chart on that momentarily. But a scenario in which some of the inflation momentum does not dissipate for the rest of the year, but at the same time, the market gets impatient and starts pricing in higher rate hikes, which then causes asset prices to crumble. That spills over into the real economy, and as a result, we see sharply lower growth. Yeah, a scenario where growth is sharply lower and inflation hasn't quite come down will feel like as much of a stagflationary outcome as any. And that, again, is I would say, 20-25% scenario out there.
20 to 25% scenario. I mean, these are real risks that we're talking about.
By all means. By all means. Yeah. Look, I mean, we've had a strong recovery, especially in the West, despite the COVID-related loss in livelihoods and lives. The provisions through fiscal policy, monetary policy, have allowed these countries to come back in a very strong manner. But that doesn't mean that they're on a permanent upward trend. These economies in the West are characterized by aging and low productivity and high debt burden, and therefore their long-term average growth rates are 2% or lower. So when we talk about 2022, we're looking at 3.5% growth in the US. Well, it doesn't have to be like that. It can only happen because it is on the coattails of a COVID rebound. But if oil price spoils the picture, if conflict spoils the picture, we could just head back toward the trend quicker than thought.
And $30 trillion of debt on top of all of that too. Now, as I was just talking about, you do have some really interesting slides, Taimur. So let me hand over to you to take us through some of those, and then then we'll come back.
Let's do that. Okay, so let's go to the first slide, which has 4 themes that I want to cover. As you can see here, of course, we've already talked about inflation. We'll talk a little more about inflation, and then I'll sort of spell out our Fed call, and there are a couple of scenarios around that. We're not gods. We don't know exactly how the future will turn out, but we can give you some path dependencies about, this is the way things will pan out if this is the way things happen. We have to talk about Asia, and we'll talk about regional implications of that. And then we'll share some research that we have done lately where we look at Asia in the context of the rest of the emerging markets, so a large-scale study of emerging market vulnerability, and see where Asia stands. So we'll do all that rather quickly. So let's move to the next slide. and Oriel, I talked about this a second ago. So on the left-hand side of this panel, we're looking at what we call inflation momentum. So it's a measure of 3-month over 3-month inflation annualized. And you can't really tell the difference between the data point for EU and the US. And that's what I meant earlier, that inflation is a bit of a global phenomenon, and it's not US-centric. US monetary policy focuses on domestic factors, but actually there are global factors like fuel and food at play, which has pushed up headline inflation substantially. Asia also has seen inflation bottom out, but still at a much lower rate than what we have seen in the US and EU. And therefore, we're not seeing global market necessarily punishing Asia for risk of inflation or risk of monetary policy falling behind the curve. Asia is being reactive, very patient to whatever is going on in the US, and it will remain like that for a while. I don't really see inflation becoming a major headache in Asia for the time being. A lot of countries have domestic supply of food that is in balance. Some of the countries are exporters of commodities. So even if inflation were to go up, the risk of their economies suffering or markets punishing them because their rates are too low, I think is relatively muted for the time being. And the other thing, and again, we touched upon this already, is that although inflation has become a bit of a global phenomenon, inflation expectations are still fairly well anchored. There are many ways of looking at inflation expectations. The one that I have here is a preferred measure for the Fed officials as well as in Bank of England, which is you pick it up from the swap market, 5-year forward, 5-year inflation swap. And it's telling you that inflation expectations have picked up a little bit. But when you stretch the time horizon, go back to, say, in the last 8-10 years, it's no different from what it was 8-10 years ago. It just isn't as deflationary or as depressed as it was a couple of years ago. That's about it. So normalization, not like, complete panic and challenging the Fed's credibility or anything like that. Okay, so that's the headline question. What is the underlying story? So let's go to the next slide, where I have put up issues related to shipping and wage. Now, shipping is an issue. We have had, in the case of China being the factory of the world, ports did close time to time around COVID and will probably close again in the period ahead. And that has caused some degree of volatility around production and shipment. But the real shipment-related problem has been in the U.S., where ports have become congested, overburdened with containers piling up, workers not coming because of COVID, and as a result, a perfect storm of excess arrival of shipment at a time when manpower has been constrained because of the pandemic, and as a result, delays, higher costs, and so on. As you can see, the Shanghai to LA container shipment price is just astonishingly high. It costs you $10,000, $12,000 to move one container. It cost less than $2,000 just a few years ago. And that, of course, feeds into cost of shipment and materializes in product prices. The Baltic dry freight, however, has more or less come down to earth. China's demand has slowed. So when we think about inflation, the demand drivers, it's a global phenomenon. China is the biggest source of demand for various commodities and metals, and their slowing has certainly had a sobering impact of that sort of shipment. But as far as U.S. domestic demand is concerned, that remains rock strong, at least for now. But as you can see, even there, the Shanghai LA container freight rate has come down by about 15% or so in the last 2 months or so. But what is causing strong demand? Oriel, I'll share with you one statistic. Purchase of recreational durable goods, so think about PlayStation to exercise bikes in the US, are up 40% in real terms on a 2021 to 2019 basis. So 40% jump in stuff that we don't have to buy when we're buying. And then Amazons of the world would have to supply them, and as a result, shipping gets stretched. Why is all this happening? Consumers in the US got major cash transfers. Consumers in Singapore got cash transfers. Consumers elsewhere did. And they are thinking about whether they want to come back to work or not. They don't like the kind of work that they used to do in the past. All those things are coming together in a perfect storm of stronger wage demand at a time of tight labor market and very formatively transforming landscape for employment and the nature of work. So if you see this chart that I have in the US, the employment cost index, the wages in manufacturing, wages in construction, these are all up 5-6% on a year-on-year basis, pretty high numbers. But look at the line, the red line, which is the hourly wages in restaurants and hotels and spas and concert halls and so on, that's up double digit, and that's where a lot of hospitality lies. That's where lots of people will be spending their money going forward because they can step out of homes now and see those wages going up further and further. And that's what keeping Fed officials awake at night, that very strong pickup in wage momentum in certain sectors may spill over into all the other sectors. Let's go to the next slide and move beyond shipping and wages to commodity prices. You and I have talked about it already a bit. I wanted to impress upon the point that some commodity prices may be commanding headlines, but they've been commanding headlines for so long that their contribution to inflation is actually beginning to fade. So take, for example, base metals. They went up a lot last year, but they haven't gone up a lot more since then. So the level is high, but the year-on-year contribution to inflation is almost down to zero. Same with precious metals. We're talking a lot about gold inflation, but how many times we've talked about gold heading toward $2,000 over and over again? So on a year-on-year basis, and that's what inflation is all about, the year-on-year delta, actually gold is not that particularly high. Brave words from me. We can talk about this 2 weeks from now to see where gold goes. Similarly, in the case of oil, which is the red line in the bottom right corner chart, and we can see that the red line is up about 50% on a year-on-year basis. So the spike that you see on this right corner of this chart is all extraordinary spikes, right? In the course of last year, we had natural gas and coal prices up something like 250%, but that was coming off very depressed levels of 2020. 2022, things were going to normalize. They were going to come down to earth, like up 10, 20, 30%, not like up hundreds of percent. Now, will that happen? Let's see. I still think it would, assuming that the conflict around Ukraine is localized. We have massive amount of oil coming on stream if the Iran deal works out with the U.S. We have U.S. shale producers about to kick in a high gear as far as oil production is concerned. So even if demand is picking up, there is supply on the margin. Odds on they will come into play, and we will see they play a constructive role in the inflation story, not a destructive role. So wages, a concern. Shipment was a big concern. Hopefully, we're beginning to see signs of that peaking out. And then there's the issue of commodity prices, where was some degree of confidence that we will have base effect driven disinflation, but Ukraine could be a spoiler. So what would the Fed do in this context? So let's go to the next slide, and then move on to the following slide. So I have for you, I hate to do this. I normally am not a big fan of elaborate slide, but it's hard to sort of talk about this without putting some concrete parameters on the table, because we're talking about multiple scenarios for 2022, along with our assigned probability. So there is a decent chance things work out. What do I mean by things working out? You could have unemployment gains continue. You could have some degree of strong wage growth, but core PCE inflation starts coming down on the back of base effects, and not sort of astonishing demand for recreational goods that we saw last year, because there was only so many exercise bikes and iPads you could buy. And in that scenario, we're talking about 5 rate hikes this year, 125 basis points from the Fed, 3.5% U.S. growth, and asset prices, in my view, will not be devastated by that. There will be some blood on the platform because some companies probably cannot deal with higher interest rates. Some asset prices may look a bit frothy around even marginally higher interest rates. But overall, from a market dynamic perspective, we think liquidity will remain ample, notwithstanding quantitative tightening. We think real interest rates will be manageable. We think that overall sentiments will be positive because the Fed would do all of these things in the context of strong demand. Scenario 2 is equally plausible and a bit more challenging, which is that inflation doesn't come down that easily. Some of the things that we've talked about, the wage demand in the recreational sector spills over to the other sectors. The Fed is a bit late in responding, and as a result, through the course of the summer, we keep seeing strong wage demand feed into stronger prices, and that wage price spiral then keeps core PCE inflation in the 3 to 4% range. That would be a bit problematic for the Fed. It would have to probably ratchet up its rhetoric, hike maybe by 50 basis points once or twice, and so we're talking about 150 basis points in total rate hikes. And growth does suffer a tad, particularly the property real estate market, which swoons a bit around that. Expectations are dampened. Growth falls below 3, and then there is some downside to asset markets. Now, the third scenario, not a very small probability, I'm talking about 1 in 5, is that it all goes horribly wrong, in which unemployment actually suffers because everybody starts expecting the Fed to uh, really tighten the screw, 200 basis points in rate hike, core PC's inflation raging at 4 to 5% at the end of the year, major questioning of the policy error, if you will. First, not hiking quick enough, and second, hiking too much, and then midterm elections. All those things get into the way of a really unhappy 2022, and that's where Oriel, your sort of stagflationary question comes into play. Inflation at 4 to 5% at the core level, with growth substantially below 2, will certainly feel like stagflation. All right, let's move on. Because we talked a lot about the U.S., but we're sitting in Singapore. You're sitting in Australia. We need to talk about the region. So if you go to the following slide, which sort of looks at, yes, thank you, U.S. Treasury curves. What we see there is the shift of the U.S. yield curve has already had a sort of a concomitant impact, if you will, in the cost of borrowing in Singapore. And I'm putting Singapore here as a very good sort of counterpoint to what could be awaiting for Asia, because Singapore has fairly liquid, deep markets, and therefore what you see in the US would translate here pretty quickly, but you'll probably see that happening elsewhere too. And lo and behold, we're seeing that in terms of higher spreads for sovereigns in Indonesia, India, elsewhere, and so on. But Singapore is a very good bellwether. So as you can see, in 2020, we were looking at long periods of stagnation and very low rates. The market was pricing in years of interest rates remaining below 1%. Then by the end of 2021, the view had changed and become rather boisterous and expecting at least 4 rate hikes by the Fed within a 1-year horizon. That's the black line you're seeing, and the single dollar curve started to steepen as well. And now, over the last 7 weeks or so, or 6 weeks or so, we've seen even further shift of the yield curve. And now we're talking about long-term rate heading toward 2.25%. Singapore is now seeing long-term rates well over 2%. And then the curve in the US, deep at the short end, flat at the long end, tells you a bit of a challenging backdrop that they'd have to hike a lot. And that might mean, for some slow outcome going forward in the longer end. In the case of Singapore, whether it's the property market or the market for sort of leverage purchase of goods and services, you would also have some degree of that challenge spillover as rates go up in the U.S. and has an impact on money markets, interest rates, and so on in the region. Go to the next slide, where we need to see both in terms of funding cost and spreads. So the U.S. dollar funding conditions have been exceptionally accommodating over the past couple of years. So we had a bit of a panic right around when COVID sort of went from being a Wuhan story to a global story. But after that, the Fed moved in with its big bazooka, and we've had exceptionally accommodating liquidity since then. But as you can see, all good times come to an end, and we are now seeing the dollar funding costs begin to go up a bit. A bit is completely fine. We can be abnormally low, close to zero for years and years, especially when we are moving past COVID. We are displaying strong growth. And as a result, spreads at emerging markets are beginning to go up as well. Still very manageable, very compressed by historical standards, but they are not at the very bottom. They're beginning to go up. So we need to be cognizant of that. As far as the region is concerned, there may be inflationary. One does not probably have to worry too much about inflation, as I discussed earlier, but we don't live in a moat of a world. We are an interconnected world, especially the financial markets are highly interconnected. Rates going up in the US will have a knock-on impact in the region. I think Singapore is a very good case study as to what's awaiting the region for the rest of the year. Okay, so now let's go to the final point that I wanted to talk about, which is as rates go up, as dollar funding costs rise, what are the implications for the entire emerging market space, and where do the Asian countries that we look on a day-to-day basis fit into that bigger picture? Because when you're talking about a large asset manager, a large portfolio manager, they don't think about Indonesia or India in isolation. They think about India, Indonesia in conjunction with Brazil and Argentina and Turkey, right? So we need to think in global terms because our markets are influenced profoundly by global investors. So what we did in this study, and I'll go over very, very briefly the key metrics that we use, is that countries that have overvalued currencies will have a hard time. in a rising rate environment. Countries that have a lot of debt will have a hard time. Countries that have large current account deficit will have a hard time. Countries that have a huge amount of funding requirement for this year, for debt repayment, for current account, will have a hard time. So very logical things that investors think about a country at a rising rate challenge type environment. So at times like that, you can take all those metrics and start scoring them. Who has the best cover, who has the best reserves, who has the best buffer, and then when we look at a bunch of indicators like that, can we create some sort of a composite score? So we look at 25 key emerging market economies to do this study: Latin America, EMEA, Middle East, Southeast Asia, North Asia, all of them, and this is what we get. So the next slide is a very colorful heat map, largely unreadable. I would urge everybody on this call not to squint and try to read the numbers. I'm just illustrating a point that you can score a bunch of countries across a bunch of parameters and create these nice heat map of ranking, and then create some sort of an equal weighted composite rank that allows you to sort of see from global investors' perspective which countries look green, which countries look amber, and which countries are flashing red. It wouldn't surprise you to know that if you were able to be squinting and zooming on this chart, you would see countries like Argentina and a few other countries in Latin America like Colombia scoring very, very poorly, whereas by and large Asian countries don't do that badly. All right, let's look at Asian countries in a little more granular detail in the next slide, which I believe will be my last slide. Yes. So it is important to keep these exercises in context. It's not just about where you stand today vis-a-vis those 25 other emerging market countries, but where have you been in recent years? So that exercise that I showed you, the heat map, that was a static snapshot of where the heat maps lie now. What you are seeing right now is repeating that heat map exercise year after year to see where the rankings of these countries go. So Philippines used to be ranked decently. Number 3, 5-6 years ago, had a pretty strong current account buffer thanks to their services account, remittances coming in, helping out. So whatever trade deficit they used to have was amply funded by the capital account surplus that they were getting. It slipped a bit. Its reserves, its payment buffers, its exchange rate are not as conducive as it was. So from being ranked number 3 in that 25 country analysis, they're ranked number 8 today. But when you think about countries like Taiwan and South Korea, they're hardly emerging markets. They're like developed market economies. They just happen to be in a bunch of EM indices, and they have ranked consistently in the top 3 or top 4 in this exercise. Thailand, unfortunately, has slipped a lot. It used to be one of the best performers in vulnerability rankings back in 2016, number 2 in that 25 country exercise. Today, they're ranked number 11. So that tells you the slippage over time on a country is, again, current account, payments buffer, debt overhang, and so on. The second group of countries are on the second slide. I'm just amazed by China's slide. China was not super high. It was ranked number 9. It's a gray line here on this chart. It is now ranked number 14. So it's actually not even in the top 50% of the emerging market vulnerability ranking that we did. It is in the second 50%. Malaysia has slipped, but it was never that strong. It just picked up a bit in the last couple of years, has slipped again. Although you may have heard me say earlier that higher commodity prices may help out the likes of Indonesia, Malaysia. We'll see. But yeah, that could probably help that in 2022. So not all these rankings can be taken in isolation. You have to see it in the context of what's the macro outlook right now. The country that has sort of moved up in a discernible manner would be India. Looked pretty weak back in 2016, was part of the taper tantrum sufferers in 2013, has picked up just one notch in the study over the last 5-6 years, but India just looks and feels a little stronger because of its very, very strong reserve buffer. So even if debt is higher, it's not that big a deal. So that's the bottom line, that for Asia, the look and feel is not alarming. When you look at a vulnerability analysis like this, the first thing you take away is that there's not a single country in Asia that is from 18 to 25. So we have none of the laggards, and we do have a bunch of the top scorers, 2, 4, and 8 would be South Korea, Taiwan, and Philippines. And then we have a bunch of countries in the middle, but they're large countries. They have significant domestic demand to rely upon, even if external environment turns rough. So I wouldn't worry about China, India, Indonesia that much. I would have worried about them, particularly India and Indonesia, much more 10 years ago when the last big fear of rate hikes really spooked the markets. Going into 2022, rate hikes in the US will have some challenges for fundraising, for balance of payments stability, for exchange rates in Asia, but there are many other countries in emerging markets which will be in far tougher shape than Asia. So when we're talking about a global sell-off, everybody will suffer, but the silver lining for Asia is that at least the fundamentals suggest that the suffering, the sell-off would be much more muted than many other emerging markets. I'll stop right there, Oriel. Back to you.
Taimur, thank you so much. I mean, as I said to start off with, you tell a wonderful story, and you've made me feel, I have to say, after listening to you, just that little bit more optimistic as to how I was feeling when we started this conversation. I wanted to delve a little bit further deep down into what's happening in China. I mean, in the second half of 2021, obviously, we saw that slowdown come through. Did the authorities there over tighten? And if yes, is that over?
Oriel, I think the Chinese government is just like any other government. They work with a lot of imperfect information. They work with, or to put it another way, they work with limited visibility. They're not omniscient or omnipotent, even if it's a one-party system and even if there's a lot of surveillance going on in the country. Managing an economy of 1.3 billion people, enormously complex, enormously hard. So they do make mistakes. They have shown a propensity to correct their mistakes. That's one good thing you can say about China in the last few years. So did they over-tighten last year, and is it going to haunt them this year? The answer is, I think, no. I think they tightened with a high degree of confidence that a slowdown may manifest in sharp asset price correction, but that doesn't really matter. Would it materialize in a massive collapse in the housing market? Well, there may be some correction, but an outright collapse where people don't get their apartments delivered or banks go out of business, that will not be allowed to happen. So China.
Go ahead.
And I was just going to say that, so for China, the tolerance level of pain from the need to normalize policy, to right some excesses in tech or property, can be pushed through. There is no election cycle to speak of. So what would seem like a very daunting thing to do rather unpopular thing to do in the West, the Chinese can push them through. So what they have done is basically taken on the might of big tech, taken on the might of entrepreneurs who are becoming very powerful and very wealthy, and maybe in a very heavy-handed manner. It certainly has not translated well for the rest of the world looking into China. But at the same time, if you look at the agenda, which is greater accountability of large tech companies, or stringent look at how data is being used across platforms and is being shared, or going after companies that sort of monetize children's need for education. Many liberal democracies in the world would like to actually implement some of that agenda, but it's simply not possible. Particularly with respect to the treatment of data and the reach of big tech. But the property market is an entirely different story. China has sort of lived through bouts of property market exuberance. A lot of wealth creation in China over the last few decades has been through the property market, as it is in most developing countries. And now what they're saying, to paraphrase Xi Jinping, property is for living and not for speculating. Well, it's a pretty strong pivot after a couple of decades of, cheering on the property market and talking about how people are becoming wealthy over property valuation, pulled the rug out of them. And the outcome is, full of pitfalls. Large companies can go bust. If large companies go bust, banks that lend to them could go bust. That could lead to a massive loss of confidence. So you would have to be very careful that none of those things materialize. And I think that's the tricky balancing act that the Chinese have tried to pull off. And so far, Oriel, look at this. I mean, over the last 6 to 9 months, we have had credit events after credit events, but we have not had any bank runs. We've had major consternation and concern about the viability of certain sectors in China. We have seen significant panic about the equity market outlook, but at the same time, fundraising environment, inflows from global investors have continued unabated. So it's not been an unmitigated disaster. It's been a painful journey. Some of it is was probably inevitable. Some of that probably could have been done in a slower pace, but that's Monday morning quarterbacking. They dealt with imperfect information, and I think they're doing the best they can.
Now, Taimur, we're going to be opening for questions in just a couple of minutes' time. But before we do, this is something you and I have spoken about before, and I absolutely can't let this video conference go without talking about the digitalization of the finance world as we see it right now, and where we're at, because crypto, of course, is becoming more and more common in people's vocab. And, you know, people who didn't know what Bitcoin was even 3 or 4 years ago absolutely know what it is now. What are your thoughts? I mean, is a crash in crypto a real risk here? Because that's going to be an additional hit to confidence.
Right. I mean, crypto is super volatile. I mean, Bitcoin was $65,000 6 months ago, and now today is, up 40. So it has an implied volatility that would make VIX look like, a fixed income instrument. So the volatility is here to stay. It's not for the faint-hearted at all. But the idea that it's just a fad and it is just one more regulation away from being destroyed, I think the time for that sort of pronouncement has gone. Crypto is here to stay, Oriel. The use case is there. The threat from crypto that might cause disintermediation of banking sector, disintermediation or dollarization of economies, those are there. But I think central banks around the world are beginning to learn to live with them to some extent, a mixture of regulation and innovation as opposed to outright regulation or unfettered innovation. They're trying to find a balance. And now you have all the multilateral organizations in the world deeply involved. You see central banks becoming part of the digital currency space and finding tantalizing and useful use cases on remittance, on trade credit, the use of the digital ledger, the blockchain, the settlement system, and so on. So cryptocurrency, privately issued digital currency, may have not the possibility of becoming a single global currency. And I cannot see Bitcoin ever rivaling the US dollar. But can Bitcoin or Ethereum or a wide range of private currencies in the form of a stable coin or in the form of a algorithm-driven limited supply currency that is just held by a small but dedicated group of people? Absolutely. I think that is very likely. And as you can see, the large tech companies in the world moving into the world of virtual assets, whether it is NFT or just buying various virtual clothing and virtual goods in the metaverse, those transactions will almost certainly happen either through central bank digital currency or private digital currency, most likely both. So it's not going away. It's here. Valuation, impossible to tell, but many currency valuation is impossible to assess. We have been saying Japanese yen has been undervalued for like 5 years and it doesn't go anywhere. So let's not be that dismissive about cryptocurrency simply because it is hard to value them. Clearly, some people want it, and clearly there is a supply demand and there's substantial transaction. Oriel, here at DBS, we have our own digital custody platform called DDX, and I just saw the latest number. I think it's already $1 billion plus in terms of transactions taking place. It didn't exist a year ago, so that tells you how real that virtual world has become.
Wow, 1 billion transactions in a year. That is
$1 billion worth.
$1 billion worth of transactions in a year.
Right.
That is phenomenal. So no valuation for us on Bitcoin.
I mean, if it had shown a propensity to be a very good place to hide at times of stress, I would have said, yes, now is the time to buy Bitcoin. But it actually hasn't. It actually seems to be something that rallies at risk on and sells off at risk off. So it is like equities. It's not like gold. That's my take looking at the performance of the currency in the last year and a half.
Yeah. Okay, now I'm mindful of the fact that we've got 10 minutes left and we do have quite a few questions coming through, Taimur. So what I want to do is just have a quick look at those polls again. And of course, you can go to dbs.pigeonhole.at to vote on those polls. This is the first question. Which of the risks do you rank as the most serious for 2022? I'd encourage you to jump on and vote for us, because what we're really trying to determine here is whether or not Taimur has changed your mind over the course of the last hour. So we've got China economic slowdown, the US Fed rate hikes, Russia versus West tension, which of course is escalating even as we speak, the emerging market debt overhang, and I'm not sure. So we're waiting for some of those results to come. Overwhelmingly, it seems that it's rate hikes at the moment, but we haven't got any I'm not sure's, Taimur, like we did last time. Perhaps what we'll do is, while we're waiting for those results to come in, if we keep that poll on screen so that people can see it, let's go to some of the questions that are coming through at this point. Now, while you're on the widget, if you are on the Pigeonhole widget, we'd encourage you please to leave feedback for us for this event as well, because of course what it does is it makes us do an even better job for you next time around. So do leave some feedback at the end of our webinar today. So let's get to a question here, Taimur. Which is worse? This is from Anonymous, the pandemic or the Ukrainian crisis?
Oh, of course, the pandemic. We're talking about 4.5 million people that have died in the last 2 years. And so the pandemic is once in a century. Let's hope and pray it's once in a century. Wars, unfortunately, happen every 5-6 years around the world. Some we pay attention to because they fit into our narrative of the world. Some we just ignore, things that are happening in Yemen. Doesn't even make it the headlines, but there is been a war going on there for years and years, right? So clearly, one war can almost never, other than a world war, inflict the kind of pain and suffering globally that has been inflicted by this pandemic. It's shown us truly that all these wars over borders and nationalities and identities are so meaningless when it comes to the virus. It doesn't care about the borders. Even a country like Australia that seems like a cocoon from the rest of the world, COVID came and it raged through the system. Similarly, countries like Singapore, which was so good at controlling the virus for such a long time, and how incredibly law-abiding Singaporeans are. There was no, mask-off movement here, and still it raged through the system. Even today, 25,000 cases on a per capita basis. That is like the worst of what the U.S. had seen. So the global response to the pandemic, the vaccine development, the antiviral treatment, all of those, the resources that have gone into it, the effort, that's like, to me, it's like one world war type of, effort and casualty and scar and hopefully some positive legacy. So compared to all that, what's happening in Ukraine will command a lot of headlines today and tomorrow, but I don't think 20 years from now, we're going to look back at this Ukraine crisis as a pivotal moment in the history of mankind. But not 20 years, but 120 years from now, people will still be studying the 2020 to 2022 global pandemic.
Oh, absolutely. You're spot on there. And I do hope you're right when it comes to Russia, Ukraine. What I do want to point out, though, here is, Taimur, it looks like you did change some minds by the look of these results. Look at that. 66% is now Fed rate hikes, even though if we went back to slide 12, where you actually rated the chances of how many
Correct.
rate hikes, the worst case scenario was only 20%.
Right. No, I think that also the discussion that we had, that markets tend to shrug off armed conflicts pretty quickly, may have played some. What I really, really like, Oriel, is that 25% of the respondents were I'm not sure in the first round, and we're not at zero with them. So that's good. I like that.
Yes. You've absolutely had some wins there. All right, let's go back to another question which has come through from our viewers today. What are some of the macro vulnerabilities for key emerging market economies, and are there any immediate action that can be taken there?
So when you come to action, we sort of start going into what can the IMF do? Can it create like a credit line for emerging market countries and so on? So that's a very big discussion, and I don't think anything major is going to happen this year. Whatever crisis response mechanism were put in place in 2020 in terms of offering struggling countries with a debt moratorium or some degree of cheap financing to deal with the pandemic. Beyond that, there won't be a lot out there this year. So when we talk about vulnerabilities, look, at the end of the day, the key vulnerability is, do you have the means to make your payments? This can apply to your budget. This can apply to your current account. This can apply to your private or public sector debt. So in all these cases, if a country shows low reserves or low reserves relative to all the dollar payments they have to make this year, then that country is in trouble. So this is why both India and Indonesia suffered a great deal in 2013 during the temper tantrum because their buffers were small relative to their payment needs. Now, coming into 2022, countries like India and Indonesia have smaller current account imbalances, higher reserve positions, and their average interest rate on debt is a bit lower thanks to years and years of low interest rate. So they're in far better shape. But to me, capacity to pay your bills, your dollar bills, your local currency bills, is the key metric for vulnerability, and you can examine it across multiple dimensions, which is what we try to do in our vulnerability exercise. So if that is the key vulnerability, then the solution is, of course, tautological. You have to have higher reserves or lower debt or both to make sure that the markets don't punish you at times of higher interest rate. It's not possible to go out and increase your reserves other than, stop importing or find some miracle new export. So I think the key thing a country can do going forward is to convince global investors that their debt profile is responsible, they're not borrowing a lot more, or they are going to increase the maturity of their debt. They will find ways to have domestic participants and foreign participants take part in the sort of restructuring or lengthening the maturity of the debt profile. That would be the strongest signal that countries can show.
Okay, so let's bring up the second poll question here, Taimur, because this was an interesting one, and given our conversation today, it'd be interesting to see once again if we've changed any minds. Which asset class do you think will perform the best in 2022? Is it developed market equities, emerging market equities, developed market bonds, emerging market bonds, or cash? So let's leave that up there for a moment while we get to quite an interesting question here that's come through. This is more of a broader question, Taimur, but most Asian economies had relatively limited trade and financial ties with Russia or Ukraine, but there is with China. Are there any implications there?
Now, China and Russia have their emerging symbiosis, if you will. Russia sits on a lot of gas. China, of course, is insatiably thirsty for energy, whether it is gas or oil or coal. It simply does not produce enough. So from that perspective, there is an intersection of convenience, if you will, that if the West says, we don't want to be determined on Russia's gas supply, well, Russia will have to find a different buyer, and of course that buyer would be China. So we need to keep that connection in mind, that although we may not be directly exposed to Russia and we have a lot of exposure to China, but through China we are now becoming more exposed to Russia and China's well-being to some extent, or its sense of energy security would stem a lot from its relationship with Russia. So from that perspective, there is a connection. But generally, beyond this specific issue, is an overall sense of whether the world is becoming polarized, that you've got the Russias and Chinas on one side and the Western countries on the other side. And by West, I also mean the likes of Australia, New Zealand, Japan, Korea, because they seem to be firmly on the side of the U.S. in these fault lines as opposed to being with China or Russia. And then what about the rest of us? I mean, where do we fall in between? Because as you know, particularly where we are in Singapore as well as in ASEAN, these countries are equally close to both the U.S. and China. And if we're going to have this sort of a civilizational fault line that's going to persist for the rest of our lives, it will make our lives very difficult, because these countries would much rather do trade and maintain secure and civil relationship with both sides of the planet. So to circle back to that immediacy of the question, that should markets and countries in Asia be vulnerable to further conflagration in Ukraine? And the answer is, well, yes, to the extent that it has an impact on commodity prices, and B, to the extent that it contributes to this deepness or deepening of this polarization, which fortunately, Oriel, it's kind of inevitable, it seems.
Yeah, absolutely. Certainly seems the way the world is going right now. Taimur, we are just out of time, but just briefly, let's have a look at the results of these polls. Developed market equities up there at 40%. You answer the question for us, Taimur. Which asset class do you think will perform the best in 2022?
So I think there is a very strong case to be made for emerging market equities this year because they're cheap from a valuation perspective. And as we saw in the charts earlier, that inflation will probably play less of a headache for them, unless, of course, we see oil at 130, 140. That's problematic. But assuming oil is 100 to 110 and then comes down as Iranian and U.S. oil supplies come in, emerging markets will have its moment in the sun, in my view, in 2022. So I will go with the 30%.
There you go. There you go. Taimur, such a pleasure to chat with you today. Thank you so much for coming on board. I think you've answered a lot of questions for our viewers today. Thank you.
Thank you, Oriel. You've been great.
Now, we are, of course, at the end of our webinar today. Great to have you all with us. Thanks so much for joining us. Just a final reminder to please leave any feedbacks or comments, or even tell us about a topic that you'd like to hear about in this series. You can scan the QR code, of course, on screen, or access the link through dbs.pigeonhole.at and use the passwords Insights 2022, and from there you can access that post-event survey. Stay tuned, of course, for the next Economic Insight, which is coming through in Q3. Thanks again, everyone. Do have a lovely evening, a lovely afternoon, and thanks again for joining us.